You're an agribusiness executive navigating an increasingly competitive market while trying to grow your company. Mergers and acquisitions are pitched as an accelerant to growth, but many M&A deals destroy more value than they create. Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches for successful mergers and acquisitions. Here's your host, the Integration Pacesetter, Joe Mosier.
Hello and welcome to another episode of the Pacesetter Pod. I'm your host, Joe Mosier, and I appreciate you joining us today. We know that in any environment, the pace of growth via mergers and acquisitions is far greater than that of traditional organic growth trajectories. So think about acquiring your competitor and having immediate access to their book of business, their customers, their suppliers, those relationships, their products, their technologies, their intellectual property, versus what it takes to build that business from the ground up. Walking up every driveway in the county to talk to farmers, going into every ag retail location to figure out what their product mix is and how you might have products that could supplement their portfolio. Talking to every hog feeder or cattle feeder or poultry feeder to say, where are you buying your feed? What's important to you? What are you not getting today that you might need? All the ways that we grind it out year after year, slowly and steadily building a business versus a merger or an acquisition, which jumps you right to the front of the line. Albeit with a bigger check that you write in the front end, but it immediately puts you in a position to start capitalizing on the value and realizing the growth that comes from it. If you've been listening to the Pacesetter Pod for any period of time, you know that our focus is on raising your awareness on the dangers, the risks, the perils that come from doing M&A poorly. But I also fear that over time we started to sound a little bit like Chicken Little. Like we're only pointing out the downsides. We're only talking about what can go wrong. We're only running around screaming the sky is falling. And we haven't stayed rooted in the true and compelling elements of M&A that continue to attract buyers and business owners to them every single day. So yes, while the risks are real, so are the opportunities and rewards. And as I step back and think about where we're at today, the economic conditions that we're in, this moment in time across the food and ag supply chain, there's a lot of reasons to be very optimistic about this business. And those reasons for optimism also are reasons to drive more interest and more potential through M&A. And so over the first dozen episodes of this podcast, I think we've well established the bear case. We've talked about the things that can go wrong. We've talked about how bad things can get when they do go wrong. And we've talked about some of the tools and techniques you can use to improve your odds of success and improve the upside. And we're going to continue to do that throughout this podcast series. But today, I think it's important that we provide a counterbalance to that bear case that we've talked about week in and week out now. And so today's focus is to talk about the bull case for mergers and acquisitions within food and agribusiness. And specifically, we're going to talk about this because we're at the intersection of three factors that are creating a really great environment. We need to talk about the impacts of a down market. We're going to talk about the opportunities that the demographic shifts, the supply chain fragmentation, and some of the portfolio decisions that companies are making are contributing to this market. And we're also going to talk about some of the big problems that ag is uniquely positioned to solve and how that contributes to the overall market attractiveness. For this discussion, I'm going to offer a take that's based very much on where we sit today in the first half of 2023. I don't think a discussion about M&A is going to benefit you or benefit anybody if we review the bull case in the abstract, if we're completely divorced from any of the conditions on the ground. So we need to look at this, and as we're doing it, we need to think about what does this mean in the current environment with significant economic dislocation, higher borrowing costs than we've seen in over a decade, significant uncertainty, and impacted trade flows from the ongoing military conflict in the Black Sea region, the icy diplomatic relationships, not just between the US and Russia or US and China, but between all the major trade partners that participate in the agricultural markets around the world. And also thinking about through the lens of lower commodity prices and the likely impact on the farmers as 2023 looks to have lower projected farm income, than the last couple of years. So let's jump in. The first point I want to talk about is that the pains of a down market are not evenly distributed. Market corrections and uncertainty right now are opening the door to markdowns in pricing and resets in valuations. And we know this is explicitly true in the public sector, not limited just to technology, certainly that we see a lot of it there, but across all the publicly traded markets, prices are softening overall. And we have the empirical data, the daily resets in the form of share prices to prove it out. And while we don't have that same empirical data for the wide base of the pyramid represented by privately held companies, family-owned companies, it would suggest through the transaction activity, through the values, through the conversations, that prices there are softening overall. But the industry is not a monolith. And so while some companies are going to be looking at a discounted value if they're exploring a sale, that just means that others are seeing deals. So for companies that are on the buy side, a down market like we're in right now is perhaps among the best times to buy. It is the immediate short-term prospects of the company that are likely affected, not the long-term value that could be created. Near-term economics are always going to make some deals right now look less rosy than they were 12 or 24 months ago. But that's where price comes in. So if the economic projections are a little bit lower and the borrowing costs are a little bit higher, a weakened price can help to offset some of that impact. For food and ag specifically, we are seeing some breakage in the M&A price discovery process from the folks that I talk to on a weekly basis. Buyers are very eager to get deals done. If they have financing lined up, if they've got the liquidity, if they have the capital on their balance sheets, they're eager to get the deals done at the lower prices that potentially are available. But at the same time, we have some sellers that are still anchored to values that they perceive of their organizations based on comps from companies that sold in 2021 and 2022 when the market was white hot. So these are disconnects that have to be worked through, but they're manageable. And so the take-home message here is that the pain of that down market is not uniform. And if you're on the buy side, it can provide a pretty rich opportunity for acquisitions that fit your strategy.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
The second topic I want to talk about is the structural industry changes that are creating an opportunity-rich environment right now. And there's a number of factors at play. We all know about the demographic shifts that are underway in the United States, and specifically within our industry, the aging ownership. There's a lot of folks that for a number of years have had the opportunity to exit. And after the last several years, the stress, the health impacts, just the fact that everybody's 3 years older, those opportunities to exit are now necessities to exit. And at the same time, we have the lack of succession plans in place and fewer intergenerational transfers of ownership within families. So more of these companies are going to be going on the market. More of them are going to not have succession plans in place. So that may make it look like an exit is the most attractive option. And a lot of them are not going to be transferring from within family ownership to the next generation. Now, some people may say the wave has crested in terms of baby boomer populations aging and a lot of these exits coming to market. But when I look around, I don't necessarily see that. Deal activity and exits were very, very hot in 2019. We did see them stall in 2020 at the start of the pandemic, but they came out swinging again in 21 and 22. And there remains a significant ownership share within the U.S. ag supply chain that is older and is ready for an exit. We also see many segments of the ag supply chain that are highly fragmented. And highly fragmented businesses or sectors are almost always good candidates for consolidation. And they're businesses that would benefit from the efficiencies of scale and from skilled operators that can roll the businesses up without disrupting service and availability to their customers. Now, we see this broadly within the ag retail space, within agronomy, within seed to some degree, and then heavily within crop insurance. Really, we see this fragmentation in most aspects of the egg supply chain that historically has had more of an agency basis or what you might call a hyper-local focus, the traditional mom and pop organization or company. We also see this in more targeted geographies when it comes to grain origination. There's still some smaller organizations out there that are in attractive locations. They have an attractive draw of production, and they have good grain handling capabilities. We see it in feed production at the smaller scale. We see it in flour milling and even in some food manufacturing. So the fragmentation, while it is concentrated within certain segments of the supply chain, it does show up across the board. And another interesting observation is that there's strength demonstrated not just by acquisition, but by divestiture. Over the last several years, company owners and executives have gotten much better at getting leaner and meaner from a portfolio perspective. It's one of the learnings of the pandemic. And as folks reevaluate their businesses, as they reevaluate the diversification that maybe provided protection in the past, they now are coming to realize that there are certain things that they do that perhaps are free cash flow positive, perhaps are accretive to earnings, but are not strategic in nature and are unlikely to grow with them as the owner. And so these kinds of businesses, when a company looks at them, they say, we might divest this. And through the selling, we may make ourselves stronger. And so what that really results then is that divestitures and companies come up for sale are not only because the owner needs to get out for age and health reasons. It may not be simply because there isn't a succession plan in place. It may not be because it is a mom and pop shop that is unable to scale. It may be a good, robust, well-run business at scale that simply is looking for a better natural owner. And that's going to create some very attractive businesses that'll be available to the right buyers. And the last thing I want to talk about is that there's some really big problems in the world that are worth solving. And these problems worth solving would benefit uniquely from inputs and impacts from the food and ag supply chain space. This requires some longer term thinking. If you're not careful, it's easy to let the conditions today blind you to all the opportunities tomorrow. So if we are in a recession now, or if we're going into a recession, short-term thinking, which for some is necessary just to survive, but for those that have the liquidity and the balance sheets to thrive, short-term thinking can leave a lot of future growth on the table. And so that's why it's important to remember how abundant the problems are that industry can address. And let's just go through a couple of examples here. Even amid the declining and in some places negative birth rates globally, worldwide demand for animal protein continues to grow every year with no signs of slowing down or stopping. What is also growing is the demands for novel and innovative ways to meet that demand for animal protein while managing risks like avian and swine flus. And while also trying to manage the trade-offs between those types of epidemics that emerge with the use of antibiotics and other sorts of addressable tools that haven't found favor in all aspects of the population globally. Additionally, the industry is well positioned to look for ways to improve and, frankly, to preserve soil health for ecological purposes, of course, but also to sustain the productive capacity of the soil that our growers need to produce the crops that are handled. Crops that go into the processing of cooking oil, that go into the production of energy through ethanol, that go into animal feed, that go into a variety of different value chains. We're well positioned to help ensure that productive capacity is maintained and improved through better soil health management. From a purely climate perspective, the ag supply chain is right up front in being a leader in finding ways to improve methane capture from animals, to find ways to improve carbon sequestration in the soil, to capture and hold more carbon in the earth than is emitted out into the environment. Finding ways to improve water utilization, which basically means using less water over time to produce the crops and products that people need to live. Finding ways to improve the production of renewable alternatives to petroleum, like biodiesel or sustainable aviation fuel. And of course, the continued innovations that we see within the precision ag space, which looks to apply less chemical to the soil, to the crop, yet still provide the upside protection that's needed to produce that crop at scale. And of course, then to bookend this with another reference to demand for protein, we have plant-based meat alternatives. And I know we're in the middle of a really brutal correction in the share prices of many of those plant-based meat firms. But those lower prices do not, in my mind, signal any sort of underlying cooling in demand for the alternatives to animal proteins and diets. The corrections are just that, they're corrections. The space got white hot, it got frothy, and now gravity is setting in. So that segment remains an important one. So these are just some of the biggest, most complex global challenges and problems that are worth solving. And you'd be hard-pressed to find another industry that is in a better position with better knowledge, familiarity, experiences to help tackle these issues. So let's recap in broad strokes the bull case for food and ag M&A. The pains of a down market are not evenly distributed, and that means that there's going to be winners and losers, with the winners in a better position than they were in the last 3 years to take advantage. There are structural issues and changes underway in our industry that are going to continue to create an opportunity-rich environment. And this is not just limited to founders and owners selling their businesses at the end of their career. It's also about finding opportunities to drive value within fragmented segments of our supply chain and the strategic divestitures that are going to put some really attractive companies on the market. They're going to put some diamonds in the rough directly in front of qualified buyers. And lastly, food and agribusiness is in a great position to address some of the most impactful problems facing a global population that's navigating the demands for food and fuel, but also trying to do that with less impact. So I hope that's a helpful review of where we're at today in the early to mid part of 2023 and why mergers and acquisitions remain a very attractive lever for growth that's worth pursuing and worth evaluating for your business. Next week, I want to jump back into exploring winning strategies and practices in the M&A deal and integration process. And specifically, we're going to talk about day one. I'm sure most of you have heard about how important day one is for an M&A integration. And beyond that statement, that may be where our shared knowledge ends. So we're going to review what is required to plan and execute day one flawlessly to really help you set the tone for successful integration of two companies. And I hope you'll join us for that discussion. Thank you as always for listening to the Pacesetter Pod today. A few things I'd like to ask you to do. First, of course, please hit subscribe on your podcast player so you don't miss any future episodes. And if you have the chance, please leave a review. That really will help us improve the content and the quality and the relevance of the content of this podcast. I encourage you to connect with me, Joe Mosier, and the Mosier Consulting Group on LinkedIn. We post regularly with observations, ideas, insights related to food, agribusiness, strategy, M&A, etc. And if you're in need of assistance or want to learn more about our proven process integration Pacesetter, I encourage you to visit us online at www.mosiercg.com to set up a call. And remember, this show is for you. So please reach out and let us know what topics are on your mind so that we can spend time investing in the things that you want to hear about that are going to help you become more successful. Finally, and most importantly, thanks again for listening, and I hope you have a safe day.
This is thepodcastfactory.com.